Investors Chronicle.
Welcome to the IC Interviews. I'm Leonora Walters, and joining me today is Blake Hutchins, co-manager of Troy Income and Growth Trust and Trojan Income Fund. Blake has worked at Troy Asset Management since 2019, before which he was at Investec Asset Management, where he also ran equity income funds, and he has also managed UK equity funds at Columbia Threadneedle. So UK equity income has been a difficult space since the outbreak of COVID-19 because many UK companies have cut, cancelled or deferred dividends. Have many of the holdings in the funds you run done this, and what have you done about them?
Yeah, you're right. It has been a tough time for dividends in the UK. And the Trojan Income Fund is known for being particularly resilient. You know, we look after the downside first before making sure we can grow our investors' capital and dividends. And so, unsurprisingly, we've been more resilient than most funds, and our investors would expect that. We would expect that, and I'm pleased that in 2020 that was definitely the case. So, of the 39 holdings that are in the fund today, actually 23 grew their dividends even through the pandemic. 8 held them flat. And so that leaves 8 that out of the 39 that had to take some action. 3 cut, which are probably permanent cuts from which they can regrow, and then 5 suspended their dividends. And some of those companies have actually come back to paying dividends already, whether that's Next or Domino's Pizza and the like. And we're probably waiting for 3 companies, only 3 of the 39, to return to paying dividends. And those are companies that have been particularly impacted by the pandemic: Compass Group, W.H. Smith, and Intercontinental Hotel Group. So I'm pleased to say that, you know, by and large, we've been pretty resilient, and that's what one should really expect from the Trojan Income Fund. In terms of what we've been doing about that, look, I think it's very important when you run an income fund not to let the income or the dividend tail, as it were, wag the dog, which is, you know, ultimately the overall fund. And so we haven't been furiously, trying to sell companies that have cut their dividend in order to replace that income in the short term. And it's something we're grateful for our investors for showing a bit of patience with us on that, because we don't think it's the right thing to do. I'll give you an example of Intercontinental Hotel Group, for example, is a company that we didn't actually own going into the pandemic. And it cut its dividend. Of course it did. It owns the franchise behind Holiday Inn Express, Crowne Plaza, Regent, Kimpton, the Intercontinental Hotel brand itself. And of course, I mean, you can ask anyone that's lived through the last couple of years. They've been very badly impacted by the pandemic, but the business, we think, is going from strength to strength. We really like those brands. We think there's a great opportunity for growth for Intercontinental Hotel Group in China and the US in particular. And so the fact it's not currently paying a dividend is okay by us. And we think that there's plenty of companies in the fund that can grow and pay their dividends. And we're willing to be patient in some of these companies that we think are going to be long-term, very healthy and good dividend growers, good investments. And so we'll stay patient whilst they repair their cash flows, and dividends will follow.
Yeah, I mean, that sounds like promising. Despite that, Trojan Income Fund's dividends were lower in 2020 than in 2019. Do you know what you yet know what you expect to be able to pay for 2021?
Yeah, so we have Trojan Income has a financial year end of January, so it'll be January 22 to the year to January, end of January 2022. There's really 2 reasons why the fund paid a lower dividend last year, and why investors shouldn't expect such a fast rebound as some may. The first one is because we didn't fall as far, and actually it was as I just described, it was a minority of companies that actually had to cut their dividend on account of the pandemic. It's not that big a factor for the fund. It will help when those dividends come back, which we expect to happen. They haven't all happened this year. Some of those dividends will come back either next year or the year after, and we'll be patient there. The bigger factor, which is the real reason why the fund's dividend was reduced, was really around us wanting to recharge the dividend growth within the portfolio on a long-term view. And it was using the volatility of the pandemic to do that. Typically, we turn over a very limited part of our fund in the year. We're unashamedly long-term investors. But when there is volatility and when there is opportunity, it comes rarely, and we've got to take advantage of that. And so really the biggest reason why the fund's dividend fell last year was because of some of the changes we made to the fund. And I'll give you a few examples. We basically traded out of some companies that we think are not going to be dividend growers in the future, that have reasonably high dividend yields, but whose business models have really have really eroded somewhat over the past few years, and we don't think have great prospects ahead of them. So on the other hand, we use the capital from those sales to invest in what we think will be the dividend champions of the future. So I'll give you an example. We sold BP and Shell, and we bought a company called Croda, which is a UK specialty chemicals business. It's got a fantastic history of growing its dividend, 29 years straight. It even grew it through the pandemic, and it's just grown its dividend 10%. And we bought that at a great price. We started buying it at £47. I think it's north of £90 now. And we just had to take those opportunities. And that comes with the impact of diluting the fund's dividend in that year we make that change. But it is absolutely, in our view, the right decision to make for long-term dividend growth and for total return. And there are a couple of other examples, such as selling Imperial Brands, which have a very high dividend yield, hasn't grown for a very long time. And we bought Diageo, which has been one of the top contributors to our returns of late. And then finally, we sold Lloyds Bank and bought investment platform Integrafin, which is an investment platform that serves financial advisors, and again is growing its dividend comfortably double digits, and we're really excited about on a long-term view. So again, we thank our investors for their patience, and what we have to do in terms of the dynamic for this year and to the end of January 2022 is we need to annualize those changes. If you think about collecting 2 or 3 dividends from these higher yielding companies last year and replacing them with lower yielding companies, it does take a bit of time for that to wash through on an annualized basis. So don't expect particular dividend growth for the fund to the end of January 2022. The good news is, when I look at the fund, the vast majority of companies are growing their dividend very nicely, and we expect to resume from January 2022 very nice, healthy dividend growth, led by some of those companies I've just named, but others as well.
Now, you also run Troy Income and Growth Trust, which plans to pay a lower level of dividend in respect of its current financial year, 1.96p as opposed to 2.78p in the previous financial year. Why is the trust doing this, especially when, like you say, UK dividends seem to be coming back, and being an investment trust, it has a revenue reserve?
Yeah, absolutely. So hopefully from my previous answer, it can be pretty clear. We are very keen on dividends from investment trusts reflecting the economic reality. So you're right, you could in theory convert capital into income and pay the dividend that you want to. It's absolutely a benefit of investment trust that you have that dividend smoothing, and we will see that dividend smoothing coming through from the investment trust versus the open-ended, in that the dividend didn't fall as far, and the dividend dynamics going forward, could well differ from the open-ended, because of that flexibility and that ability to smooth dividends. But I think it's very, very important for us, as I said, for the dividends that the trust pays to reflect the economic reality of the dividends that the underlying companies in which the trust invests pay us and generate themselves. And so the reason why the trust dividend fell, as I said, was not because of the pandemic. We can look through that, and that's exactly what we're doing on that front. The real reason why the trust dividend fell is because of these changes that we made: BP into Croda, Imperial Brands into Diageo, Lloyd's into Integrafin, which has that effect. And it would just be not reflecting economic reality if we didn't reduce the dividend. So what we would like to believe, and again, had very supportive investors who understand this, is that now this is done, now the dividend has been recharged of the trust, along with the Trojan Income Fund, we're now in we should be in dividend rebuild mode, albeit from a gradual base.
And I'm assuming that the trust and the fund's portfolios are fairly similar to each other?
They're fairly similar, absolutely. This is, if you looked at the two, there's huge overlap and huge commonality, as you would expect. The differences between the two are a couplefold. One is the ability to smooth dividends. The second is the ability to gear the trust. We don't currently have gearing on the trust, but we could do that. We have a little bit more ability to invest in some overseas companies, a little bit more in the trust than we do in the open ends, probably to the tune of 5 percentage points of capital. And then finally, there's the ability, because it's a smaller mandate versus the Trojan Income Fund. And again, this is very much at the margin. We have an ability to invest in, a few more medium-sized companies, or have weights in those medium-sized companies that are slightly larger than the open end. So absolutely, they feed off each other. The same investment process, the same philosophy, with some subtle differences that we think are appealing for investment trust investors.
The funds you run look to strike a balance between income and growth. How do you strike this balance, and how much importance do you place on each?
That's absolutely right. We are interested in total return. If you think about the Trojan Income Fund, over the past 17 years, it's basically delivered 8% compound for investors. If you look at the investment trust, in over 10 years, we've delivered, I think it's the best part of 9% compound to investors. And that comes from two parts. It comes from income and income growth, very importantly, and it also comes from capital. And we will never ignore one in order to prioritize the other. It's that balance between the two that is so important. And that balance can change over time. And right now, where we are in markets, we think it's incredibly important, and we were saying this ahead of the pandemic, is not to overweight the component that's going to come from income. It is still going to be a healthy component of that total return. If you think that we're trying to achieve that, the best part of double-digit total return for our investors over a long period of time, it's important that there's a good contribution from income. But at this point in the market cycle, when valuations are reasonably rich, when there has been a compression of yield in every asset class, I can see that from property to bonds to equities, it's really important in our view not to overstretch for yield at this point, because you run the very real risk of choking off growth and of potentially impairing capital on a permanent basis, because that yield comes with too much risk. And so for us today, if we're thinking about that, that best part of 10% total return, 8 to 10% total return, which we've achieved over 15, 17 years, we currently think that the right income balance of that is 2.5 to 3%, and it's important that that 2.5 to 3% can grow, and we would be very suspicious, or it's certainly not central to our philosophy, or it's not possible or prudent in our view to strive for dividend yields out there, 4, 5, 6%. I think that's from a different era.
Now, Troy Income and Growth Trust and Trojan Income Fund have underperformed the FTSE All-Share Index and their peer group averages since the start of 2021 and over some longer cumulative periods. Why?
The biggest reason for that, which no one likes to underperform, but we're incredibly clear on the Trojan Income Fund and the Troy Income and Growth Trust of what we're trying to achieve for investors. And first and foremost, the first role for us at Troy is to produce a resilient total return for our investors. And therefore, if you look over that period we've been running these funds and the trust, we have a rich reputation for protecting capital in market drawdowns. And we did that in the first quarter, the second quarter of 2020. And we're very pleased that the fund stayed true to its historic footprint. The consequence of that, unfortunately, it would be great to be able to get both sides of the trade and to be able to protect capital and then be able to lead the market on the way up. But that's just not realistic, quite frankly. In a low turnover strategy that focuses explicitly on higher quality companies that have an ability to produce resilient, reasonably predictable cash flow and dividend growth, it is inevitable that we will lag a market upswing. And that's really what's happened since the start of 2021. I think it was November really where this rotation into more cyclical companies started. The vaccine news that came out in November, where frankly everyone was amazed by and hugely relieved, frankly, by the fantastic efficacy data that came out from various vaccine trials. It was really as clear as anything as you get in investment markets. It was almost like a big banner that was put up that said it's now okay to buy cyclical companies because the downside has been taken away. And you saw a very violent 4 months, when in November, December, January, and I really think it culminated in February, quite frankly. And there were 4 months where the market really did rotate as people repositioned for this new normal, which was a world in which COVID was less of a threat to economies and to people's lives, quite frankly. And that's really the reason why the fund has underperformed. The majority of that came in that period from November to February. And since then, I think the market has since moved on. It's looked beyond just COVID, and it's got back much more to fundamentals. What are the companies that are going to become more valuable in the future for various reasons? And the fund and the trust has actually performed pretty well if you look from April onwards. And that's very much in line with what I would expect. And we think from here, a broadening of market returns, a much more level playing field, much less fascination or fixation on the boom and bust from COVID, and instead an appreciation of fundamentals and of businesses just becoming more valuable, which suits us.
Yes, I mean, you were saying, obviously how it evolved. Is this typical of a typical market conditions in which the funds underperform and outperform?
It is. If you look, post the financial crisis, it's another feature of the fund, and is that we protected capital far better than the market. But it's very hard for us to compete or to lead the market back up. So if you think about, for example, in 2008, the fund drew down less than half of the market, but it only captured about half of the market's rebound. And we saw that again in 2016, having massively outperformed the market in 2014 and 2015, when market returns were basically zero to negative. We again lagged the upswing in 2016. It's just a function of, it's very difficult for us to have it both ways. We preserve capital on the downside, we invest in higher quality defensive growth businesses, and it's the more cyclical businesses that frankly we would never invest in, that tend to lead the market upswing. And then from there, we think it comes down to fundamentals, which is where I think we're at.
You've been saying that you focus on quality. What's your definition of a quality company?
There's various elements that we look for in businesses, and first and foremost, it's something that means we can be pretty sure that the company will, one, be around for decades, will be able to grow for decades. It doesn't have to grow at super fast rates, but it has to be able to grow for a long period of time. And very importantly, that a company can earn good economics whilst it grows and whilst it endures. And so some of the things that we really look for from a quantitative perspective is that ability to grow at high and attractive incremental returns on capital. And really what that means, in layman's speak, is there's something about the business that means that it can be highly competitive in its industry, and in fact leading in its industry. So we love to find things like whether that's brands, benefits of scale, network effects, things about a business that means that we can be pretty sure it's going to be around, it's going to be able to grow, and when it grows, it's going to make attractive returns as it does. I mean, I'll give you an example. A company like Croda, which is now a top 10 holding in the Trojan Income Fund. As I said earlier, we bought it about a year and a half ago. You know, from the outside, you may just think Croda is a chemicals company. What's so great about being a chemicals company? Chemicals companies tend to be cyclical. They don't tend to make great margins. They tend to be quite capital intensive because they need huge factories and the like. And they tend to be, as I say, commoditized and competed away any excess return. But Croda is a specialty chemicals business, and it's absolutely fixated on producing reasonably small quantities of specialty chemicals that are absolutely vital ingredients into end products. So they produce the magic ingredients that go into high-end beauty products, or into anti-aging cream, or into shampoos. And as we know, the beauty and personal care industry is incredibly non-cyclical, and it's actually growing, and it has very good growth, particularly in sustainable ingredients, which is where Croda specializes. And they also have a fantastic life science business, a healthcare business, where they're actually providing some of the stabilizing chemicals and solutions that go into vaccines and into next generation drug technology. And for any of the listeners who have had the Pfizer vaccine, that's an mRNA vaccine. It's a brand new technology that is incredibly exciting in the vaccine world. And it's Croda's polar nanolipids that actually stabilize the active ingredients in those vaccines. So they're hugely important. They produce these polar nanolipids in incredibly high levels of purity, which gives us all confidence, or many of us confidence, to take these vaccines. And the beauty of it is that that ingredient that they produce, whether that's into anti-aging cream or into mRNA vaccines, it's a tiny proportion of the end cost, but it's an absolutely vital ingredient. So they make great economics. There's hugely high switching costs. There's often regulation involved in that. And that means that Croda has incredibly sticky revenues, sticky cash flows, and therefore it's produced 29 years of unbroken dividend growth, and we expect many more.
Now, you obviously look for a number of these attributes, including the ability to deliver growing cash flows into the future. Which particular attributes make you confident that a company will be able to do this? I mean, you obviously no one knows the future. When you sort of examining a company to invest in, what is it that makes you think, yeah, I think they will be able to do this?
A lot of it is we obviously crunch the numbers. We obviously do a lot of research. We speak to competitors, we speak to peers, we speak to the company. I think so much of it comes down to culture. And we all know businesses, whether that's companies that we like to, that are suppliers to us, or companies that we like to source ingredients from, or source goods from, or companies we've worked for in the past. And we know when a company has a good culture. And when you spend time with businesses and you take a long-term approach, I think culture is absolutely fundamental to that. And Croda is a good example of that. It's a business that takes a long-term approach, that its employees are proud to work for. There's a lot of shareholding throughout the company. They have a very distinctive culture, and it starts from the top. And there are many companies that we own that culture is one of their competitive advantages. So there are many things that we look for in businesses. I think the tangible things, or the quantitative things, wouldn't surprise your readers or your listeners. But really meeting with companies, spending time with them, and understanding their culture, I think is absolutely at the top of that list.
Is there an example of when you got it wrong, and what did you do about it?
We're long-term investors, and we are patient, but sometimes you have to vote with your feet. And there are absolutely examples where we've got it wrong. I'm glad to say we get more right than we get wrong. Sometimes if an investment case has changed or something has happened that has really undermines our investment case, we will walk away. I think one example of that earlier in the year is in our investment in IG Group. Now we'll see whether it works out to the company's benefit, but they undertook a piece of capital allocation. They bought a company in the US that we didn't really like. We didn't like what they were doing with our investors' capital. We had a very good engagement with the company on that. It was a very detailed engagement, but we could see that we were at loggerheads, frankly, and that the company were going in a direction, and we wanted them to. We thought it was best for them to go in a separate direction. So we actually made a positive return from our investment in that company. But as I said, sometimes we vote with our feet, and that's one example.
Just thinking about, I suppose, companies in difficult positions with financial pressure as a result of COVID-19, and in some cases a deterioration in financial strength in companies. I mean, has it been harder to find investments which meet your strict criteria?
I think a lot of things, when we take a step back from the pandemic, and as I say, I think it's appropriate now, particularly for investors when they're thinking about investing with looking forward, is obviously the impacts of COVID are going to be with us for quite a long time. There will be choppy waters, but I think it's important to really move our mindset away from being COVID obsessed of the next lockdown, what's that going to do for markets? The next opening up, what's that going to do for markets? The market has had a long time now to get their head around this. And instead, we've got to think about fundamentals. And I think we're in a world where the pandemic has accelerated various trends. And there are companies that, in my mind, are quite obviously becoming more valuable. And there are companies that are quite obviously becoming less valuable. And I think there may be exceptions if you are willing to trade, if you're willing to be nimble on your feet, then fine, you can make money in a declining business if you are very smart. But fundamentally, for the majority of an investor's portfolio, you want to be pointing in the right direction. There's no point as a starting point, in my view, of acknowledging that you're going to be running up or down escalator. That's very hard work to do repeatedly and to do over a long period of time. And so that's what we try and do. We try and point in the direction of companies that are becoming more valuable. And whether that's the digitization of various industries, or if that's the death of analog businesses, I think it's very clear that opportunities are presenting themselves in both directions. So I would refute the argument that it's becoming harder to find these investments. And I think the exciting thing is that the new growth opportunities are appearing as much as some of the old ones are disappearing. I'll give Next as an example. We own Next, and a lot of people still think of Next as that high street store that they've known for decades. But even today, there's a really interesting announcement that Next basically have a unique opportunity in the UK because of how well invested their digital business is, how their e-commerce offering is so large now that and it dominates the physical retail business. They earn more from online now than they do from physical retail. But they're starting to use that infrastructure, their logistics capabilities, to serve third-party brands. And today they've signed up an agreement with Gap. And I'm sure we've all heard in the news that Gap are closing their stores, that Gap are on the verge of financial distress and are exiting the UK market. Well, they've actually signed up an agreement today for Next through their Total Platform offering, which is a reasonably new offering from Next, where they basically provide the website, the logistics, the delivery, everything for these brands that have value. The brands have value. It's just the means of distribution, the physical retail, the stores, the property costs, the lease obligations, the logistics operations, having to to offer free delivery and the like is absolutely killing some of these brands, because they have sales, but their costs are too high. And so therefore, if you can outsource the logistics, the website, the returns policy and the rest to a company that can afford it, and Next, in this case, there's a really interesting opportunity. So I think we can get down about some of the things that is impacting some businesses, but there's some exciting growth opportunities if you're willing to invest behind them. And I think Next is a great case in point.
Have you sold any holdings as a result of a decline in quality?
Yeah, we do. I mean, it's something that we're always judging. It's not just about whether an absolute return on capital or absolute profitability is high. It's the direction of that. A very poor investment would be, which is why I'm so against, for us, very screen-based investing. If I was to look across the market and very simply screen for some of the things that I've said I look for, such as an ability to grow, if I looked at historic growth as one of my key metrics, if I looked at high return on capital or high margins as one of my inputs, and I just bought every company that had grown and had grown at high margins, there would be some absolutely terrible investments in there, because the past is not the future. And so it's our job to make sure that we're investing in companies that are becoming stronger, that their incremental margins, their incremental returns on capital, their incremental growth is very healthy. So we've absolutely done that. I've spoken about one that comes to mind already, and I've spoken on the opposite hand on something like Next, which we think is kind of deepening its competitive positioning and has opportunity as a result of that.
One of your co-managers on the income funds, Francis Book, is due to step back at the end of this year. How do you plan to manage this? Will you get extra staff resources in place, or what are you going to do?
Yeah, this has been a very seamless handover. Francis has been managing the fund for 17 years now. He is also an executive director of Troy. He was one of the first members of the Troy investment team, and is a shareholder in Troy, as am I. And so Francis has always had two roles within Troy. One has been managing the income fund, and second has been helping to manage the business. And so whilst he won't be doing the former anymore, managing the Trojan Income Fund, that will be me and my team, he will still be doing the latter. So he is still very much involved in Troy, and will be. And I think that's very different to a lot of fund management successions, where there can be an abrupt change of manager, or the manager and the new manager have completely different philosophies or incentives for the business. We are completely aligned in continuing the great work that the Trojan Income Fund has done for the past 17 years. And for me, I'm still in my 30s, late 30s. I have 20 years in which to run this fund, and will be doing so with exactly the same philosophy and process that we've followed so successfully over the past 17 years. And we have been investing behind the team over the past 5 years, and longer, frankly. In the UK strategy, I will lead the capability, but we also have Hugo Ure, who's managed the Trojan Income Fund since its inception. He's worked with Francis for over 10 years. We've worked together now for 2 years. I have Fergus McCorkle, who's our lead analyst on the strategy, who's been with Troy for over 3 years and is a fantastic talent. And also Aniruddha Kulkarni is currently working on the strategy. He's a member of the Troy investment team. And we have an investment team of 12. And whether that's the well-known members of that team, such as Sebastian Lyon and Francis, or if it's some of the younger members who I've spoken about, along with Mark DeVos, Charlotte Young, George Biney, Tom Yowett, Ferguson and Aniruddha, we're very well resourced. And so I don't think investors should be concerned about this transition. And frankly, they won't see any difference in terms of what they've received from the fund.
Okay, thank you, Blake. A really helpful update on the prospects for UK dividends and your funds.